Before 2008, Washington largely trusted sophisticated financial institutions to measure their own risks, protect their counterparties, and solve emerging problems without direct government control. Wall Street's largest firms borrowed enormous sums overnight, traded complicated mortgage securities, and operated on the assumption that confidence would always keep money moving. That assumption began breaking when American housing prices fell, and assets once treated as safe became difficult to value or sell. In March 2008, the Federal Reserve helped J.P. Morgan Chase acquire the collapsing investment bank Bear Stearns because officials feared an uncontrolled bankruptcy could destabilize the system. 6 months later, Lehman Brothers failed without receiving comparable protection, and AIG was rescued almost immediately afterward. This sequence begs a central question. Was Washington truly unable to save Lehman, or did it make a deliberate choice not to? The answer is not a conspiracy, a secret order, or an attempt to destroy one unpopular Wall Street bank. It lies inside a collision between legal limits, political pressure, private negotiations, institutional pride, and a severe misunderstanding of how panic could spread. Bear Stearns had shown Washington that one investment bank could threaten markets far beyond its own balance sheet. But rescuing Bear had also produced an angry warning. If the government protected every reckless institution, Wall Street would never believe failure carried consequences. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke now faced two dangers that appeared to demand opposite responses. Another rescue could encourage banks to take greater risks while expecting taxpayers to absorb the losses. Refusing intervention could allow the failure of one deeply connected institution to damage every company depending on it. Lehman soon became the ultimate test of whether Washington was prepared to let a major financial institution face the consequences of its own decisions. Paulson wanted Wall Street to understand that Bear Stearns had been an emergency exception, not a permanent government guarantee. Lehman had made itself dangerously vulnerable by accumulating mortgage assets, depending on short-term borrowing, and publishing valuations that investors increasingly distrusted. During the summer, Chief Executive Richard Fuld searched for capital and potential buyers, while resisting transactions he believed undervalued the company. When negotiations with the Korea Development Bank collapsed in September, Lehman's share price plunged and its remaining time nearly vanished. Washington then turned to the leaders and specialists of America's largest banks, believing they possessed the market knowledge and capital required to engineer a private solution. Their analysis delivered an uncomfortable lesson. Lehman's assets were more uncertain, its funding needs were larger, and the available rescue options were narrower than officials had hoped. On Friday, September 12th, government officials summoned the chief executives of the largest financial institutions to the Federal Reserve Bank of New York. Markets would reopen after the weekend, leaving the group barely 2 days to prevent Lehman from entering bankruptcy. Paulson made Washington's position clear. No taxpayer-funded guarantee would support another Wall Street rescue. The assembled bankers would have to examine Lehman's assets, estimate their losses, and construct a private transaction themselves. Once that rule was established, the negotiations crossed a threshold from which every remaining option became more difficult. Bank of America considered purchasing Lehman, but the bank's uncertain mortgage losses made the transaction increasingly dangerous. During the weekend, Bank of America moved instead toward Merrill Lynch, another threatened institution that appeared easier to value and acquire. Barclays then emerged as Lehman's last credible buyer, but the British bank could not immediately guarantee Lehman's obligations without exposing itself to potentially enormous losses. British regulators required protections and shareholder approval that could not be secured before markets reopened on Monday. Washington demanded a private rescue while refusing the government protection potential buyers believed was necessary to complete one. A temporary guarantee or financial bridge might have kept Lehman operating long enough for Barclays to close the transaction, but providing that bridge would have broken the anti-bailout rule Paulson had imposed at the beginning of the weekend. Officials later argued that Lehman lacked enough acceptable collateral to secure the enormous Federal Reserve loan required to keep it alive. Critics have disputed how absolute that constraint was, and argue that political determination influenced which legal and financial possibilities officials considered acceptable. By Sunday night, the question was no longer whether Lehman was in danger, it was whether Washington would break its own new rule to save it. Washington kept the rule, and during the early hours of Monday, September 15th, Lehman Brothers filed for bankruptcy protection. With approximately $639 billion in assets, it became the largest bankruptcy filing in American history. Lehman's failure through thousands of derivatives, loans, repurchase agreements, securities, and promised payments into legal and financial uncertainty. Counterparties protected their cash, short-term lenders withdrew, and institutions began treating every unknown exposure as a potential threat. The government had attempted to isolate one irresponsible bank, but fear was already escaping into the financial system used by ordinary businesses and savers. The Reserve Primary Fund, widely treated as almost equivalent to cash, suffered losses on the Lehman debt it held. When the fund fell below its expected $1 share value and broke the buck, investors rushed to withdraw money from similar funds. Those withdrawals damaged the commercial paper market that companies relied upon to finance payroll, inventory, and daily operations. Washington now gained the knowledge it had lacked before the bankruptcy. Lehman's most dangerous asset was not something on its balance sheet, but the confidence connecting institutions around it. The lesson arrived too late to save Lehman, but it gave officials a clearer view of the larger catastrophe they still had to prevent. Then, less than 48 hours later, Washington did almost exactly what it had refused to do for Lehman. On September 16th, the Federal Reserve authorized an emergency credit facility of up to $85 billion to prevent AIG from collapsing. Officials argued that AIG possessed substantial businesses that could secure the loan, and its enormous network of insurance and derivatives obligations made its sudden failure exceptionally dangerous. AIG was therefore legally and financially different from Lehman, particularly in its available collateral and the structure officials could use to provide assistance. Yet, the sequence destroyed Washington's attempt to draw a clean anti-bailout line. Lehman was abandoned on Monday, and AIG was rescued on Tuesday. The government wanted financial institutions to believe reckless decisions produced real consequences. Instead, Lehman's bankruptcy demonstrated that a punishment imposed on one institution could travel through contracts, funding markets, businesses, workers, and household savings. Washington responded by protecting money market funds, creating emergency lending facilities, supporting additional institutions, and eventually approving the $700 billion Troubled Asset Relief Program. None of this made Lehman innocent because the bank had accumulated dangerous assets, relied on fragile funding, obscured its weakness, and failed to secure a deal while better options remained. But the crisis forced officials to abandon the belief that one giant financial institution could fail cleanly inside a system built on mutual dependence. Washington did not allow Lehman to fail for one simple reason, and Lehman was never automatically entitled to receive public money. Officials believed they lacked a clean legal and financial rescue mechanism, wanted private banks to absorb the losses, and feared the precedent and politics of another bailout. They also believed the financial system could survive Lehman's bankruptcy without losing confidence in the institutions surrounding it. That final judgment proved catastrophically wrong, and the regulations created after the crisis were shaped by the need to resolve systemically important institutions without repeating the same uncontrolled collapse. They feared that saving Lehman would teach Wall Street that failure had no consequences. What they learned instead was that in a system this interconnected, letting one institution fail could impose consequences on everyone,